Good morning, everyone. Hope you had a nice long weekend. We are opening here with maybe just a slight gap down, but more importantly on the weekly chart, just looking at what we've done so far this year, gone absolutely nowhere. Just going sideways along all-time highs. Got a couple of, technically, if we look really close at the highs and lows, we've got a small low put in that was broke here from the last week of the year. And then we came up and made a new high. And that's what creates that widening formation where you make a higher high and a lower low. And it widens the fan, if you will, as opposed to getting tighter, which would be more of a triangle. We saw that back here as well. You're getting higher highs at the same time you're getting lower lows. And then that resulted in a slightly higher high with this cluster at the start of the year. But that's a fairly tough pattern to trade. So now as we start off, last week was an inside week to the prior one. And now we're kind of at the bottom quarter of the last 2 weeks of range. And certainly at risk of breaking a couple of these swing lows here on the weekly chart to maybe push us lower. And at some point, we're going to go lower. So you might as well be prepared for it. We'll see a spike in volatility. We'll see, bigger ranges. We have seen some of those amplified daily ranges, bigger candles. But still struggling to actually go lower. And not much for unfilled gaps up here as well. There's been a lot of overlap. The trade action from yesterday is not really important since the broader market was closed. And it was inside of Friday, so it doesn't matter much as well. News-wise this week, we got business inventories and housing market index today at the top of the hour. Bunch of delayed data from housing market tomorrow morning before the bell. The FOMC minutes will be tomorrow afternoon. The minutes that were written from the last Fed meeting in February. And so that one will be in January. Those get combed through pretty with a lot of detail now, especially with AI. And so when those come out, they're trying to determine the future decisions, and so every word gets scrutinized. So that could have a little bit of market movement. That's Wednesday afternoon. Some more jobs data on Thursday. And then Friday is GDP and PMI. Those will be along with new home sales and consumer sentiment. So Friday's news, both before and after the bell, should be pretty eventful. But first 20, 30 minutes here is going to probably feel like a Monday and take a little bit to get going. So When you get a hammer within the trend and that tail doesn't stick down below the prior bar, like it's just a inside bar or a hammer within the uptrend that has not yet pulled back, I don't consider that. I mean, the hammer itself is a valid hammer, but the context, it needs to pull back a couple of candles so that the tail is sticking down below. Something like this, where the tail sticks down below the prior handful of bars. Press an AD line pretty flat. I'm kind of right in the middle of Friday's range, which was a pretty sizable range. Here in the big, actually, wait a minute. Yeah, this bar here, where we closed at the doji, Dragonfly Doji at the open. Most important thing in trading is knowing when to trade and when not to trade. If you force things, you end up making bad trades or trades that are less likely to turn a profit. And then you get underwater, and when those good days come, all you're doing is filling your hole back in, getting back to break even. So if you can stay patient on not just the slower days, but the slower time periods within the morning session, and when those winning trades come, you can be moving forward instead of just 2 steps forward, 2 steps back, or 2 steps back, 2 steps forward kind of thing. You know, you've got these big body candles with very small tails, and then one's green, one's red, one's green. Here's a doji, and not just kind of consolidating here. You could call this a bull flag coming up from lows and then consolidating. Now we're going to be coming down to the halfway back for the day. No crossover play here. Sometimes on the 512 tick chart, when you get a break of a larger halfway back, you end up with a little bounce and can take a what I call a crossover that crosses through or crosses over the larger long to take a short to kind of continue the move down to lows. And haven't seen too many of those lately. Haven't seen many good opportunities for halfway backs lately as well, which really indicates the slow consolidation in the markets, and that's what's being reverberated, if you will, in across at least a handful of traders that I talk with. Traders trading other strategies as well, not just trading the same way as me. We're going to have a 15-minute is 33.75, and then the high break is 62 and a quarter. And again, it's just sticking with that 4-point stop until we break above a 25 on the VIX, which should likely happen here. You know, if we get a couple of bigger sell-off days, I mean, even if we just go get a pullback to this daily 50%, even that, we're so close to it already. You know, that's not going to trigger a huge volatility jump just to break these lows. But eventually we will get some more volatility, and that will improve things. But for now, we do not have that. So we had a halfway back long break. We didn't stop at the 50%. Now, drawing up the halfway back short, if we break this 61.8, then we absolutely want to stay out of the middle of the range. This one didn't quite make it up to its 50% and is already trading away. So there's a better chance at this point that we break lows. And then the downside is what starts to gain momentum. But that's one thing I look for to, again, help determine if we are in a range bound kind of sit on hands environment, or if we need to, or if it's okay to be a little more aggressive. So now that we've broke to the downside, we can start looking for a bounce to the 21 and some potential short setups. And again, top of the hour have housing market index and business inventory. So plenty of time at the moment to get into a trade. But if we get into about 2 minutes before the top of the hour, that's when I pause. I believe the EMAs in Thinkorswim, Rick, are connected to. So it's exponential, means it weighs the most recent couple bars a little bit more, but also it's connected to the current price. So if you can just kind of see this blue line here, see as the price goes up, I'm going to keep moving my cursor away. See as the price goes up and down on the current candle, the 21 is just ever so slightly ticking up and down. So it's connected to the most recent price. And so as this candle forms, the 21, like the very tip or the nose, we'll call it, is kind of going up and down. And then once it closes, then that point is locked in, and only the nose of the 21 moves for the next candle. Yeah, I don't think it's enough to really make much of it, to mean much. So I know some people were asking about, 4-point stop being tight, but for the 15-minute orb, the 4-point stop being tight. But boy, last week is a good example where you really didn't get a whole lot going. There was one day went to the 20-point target, and the other 4 days were a little bit of a spike down here. The other 4 days were just kind of churning and stop outs. So you take those tiny, -4s, and then you get one winning day, and at least you're plus on the week. Not by much, but you're up 4 points on the week, on a week that just really didn't do a whole lot. We had Thursday's bigger sell-off run, and sometimes those moves that seem big on the daily chart, there is a lot of churn, especially in the morning. So, if you were to use a big wide stop every single day, you can catch, you're going to increase your winning percentage, but your average loser is going to go up. So that's where using Excel or a tool where you can, have all your trades logged, and then go in and say, okay, well, my average loser is 3 points. And what if I was able to eliminate some losers to bring that up to 2 points? Or what if I loosened my stop and had a bigger stop, and my average loser was 6 points, but my winning percentage went up from 30% to 60%? What would that do to the expectancy? Being able to manipulate that in kind of an exercise environment is super helpful. So you can really understand how the strategy that you're trading, like what affects different pieces of it. And then you can create rules and parameters that actually have an impact and are meaningful, and not just things that, a lot of times what happens is people will put on all these rules to eliminate trades from a very small data set. And all you end up doing is curve fitting your rules, which becomes your strategy, to this inverted hammer is too low to lows. It probably will roll over, but I would want us to pull back up closer to the 21. But if you create too many rules on a small data set, you end up curve fitting your strategy to 3 months of data, or even just 1 year of data. You could be in a big volatility downtrend, and you create a strategy based on that, or curve fit your rules based on that 1 year period, and then the market goes into a tight uptrend and the whole thing falls apart. So that's why having data, or trades that span multiple market environments is really helpful. And then keeping things simple. If you have 20 or 30 occurrences of something, that can start to be a little bit more of a standout. Let me dive a little deeper into this, but if something's only happening a few times, it's probably not worth creating some rules around it. And actually, in developing the auto trade 15-minute orb, I do have a couple of additional parameters, just very, very minor things, like only taking one trade on the last day of the month. So if we break in one direction on the last day of the month, not taking the opposite, I noticed that about 95% of, but you got 12 months. There's only really 10 of those that I'm trading the last day of the month. So over 5 years of data, there's about 6 years of trade data. That's little over 50 occurrences, and almost basically every single one of them, the second break was a loser. So in situations like that, I can confidently add that parameter in, because on net, even if I had 3 or 4 plus 20s that popped up, I'd still be down on net for that specific occurrence. So and then there was another, actually the other one that I thought was really interesting. On the first trading day of the month, to skip the first directional break. And first and last day of the month have a lot of interplay with, bigger long-term investing positions being put on or reconciled. And so some of those occurrences have nothing to do with technicals and more to do with, just bigger picture institutions. And so I found that passing on the first break on the very first trading day of the month eliminated again, it was like 85% of those first trades were losers. And if you add all those up and throw the winners in there, it ends up being like 150 points or something like that. But those are really the only two additional parameters. I went through and tested a whole bunch of things, combed through my data, looked at 6-point stop, 8-point stop, a whole bunch of different things that I was curious about or could think of, and just to kind of bulletproof the strategy and validate. I've done that every few years, but just once again with kind of creating the auto trade deal that it just adds that much more confidence to show that, okay, yep, the most profitable approach is, the current approach. So, and it's when you step back and look at the data, when you look at a month's worth of trades, a year's worth of trades, it's interesting. Funny here, we've got a 1 candle bounce to this inverted hammer, and then same thing here, 1 candle bounce to this inverted hammer, and at least this first one rolled over fairly hard. We'll see if the second one does too, but typically those I don't find get a strong break. And that's a really good example where, okay, 2 occurrences is not enough to create an entire strategy around. If we had 20 occurrences that we compared and we found that 18 of them rolled over, regardless of where the inverted hammer was, okay, now we can start to, take some trades with that approach and gather some solid trade data. But I would say today's a little bit of an outlier, rolling over enough to get a +6, 1 candle off lows. Now, the trend is clearly down. We've got one little less than 30 seconds till we get this business inventories and housing market data. We'll see what that does. But yeah, you just want to be careful with, creating too many parameters and no trade rules. Stuff like don't trade on certain days. I've looked at, all my trades on Monday, all my trades on Tuesday, all my trades on Wednesday. There's really nothing to pull out from that. I do tend to be a little bit more conservative on Monday and Friday. That's more just from my mindset. If I have a winning trade on Friday, I usually call it quits. If I have one losing trade on Friday, I also call it quits, just to kind of end things on a non-impactful note. If I have one winner, great. Little cap on the week. If I have one loser, stop out's not going to change my P&L for the week by that much. It's not going to affect my mood for the weekend. So, little things like that are more mental based. But what that does, and this is super subtle, but as you're going through your trades, you might look at Friday's trades and say, I trade less on Friday, or my Friday trading winning percentage is higher than the other days. I should trade more on Friday. Well, you gotta step back and say, oh, well, the reason that my winning percentage is higher on Friday is because I'm trading less, or some of these inputs that you may or may not be aware of, or subconsciously some things you do can really impact your trading. So that's where, no matter what the strategy is, it's always best to dive into the details yourself and really get to know the understanding of it. Even, with the 15-minute auto trade. Like, yeah, you can basically sit back and forget it. You don't really have to know the signals or the trade rules. But when you get through periods of drawdown, it's helpful to step back and, ahead of time, even you look at 5 years worth of data and look at, oh, there's only a couple down months through that period. Oh, every year you're positive, stuff like that. You can remind yourself when you're having, a rough week or just not getting many setups and you feel like, oh, it's really slow. Is the strategy stopping working? Stuff like that. Even with like the halfway backs, part of it is I'm not as aggressively trading the halfway backs, but it's mirroring what we're seeing on uh, the daily chart with just this consolidation, not getting follow through on the daily chart. We're not selling off and then continuing the follow through to the downside. We're not going into new highs and continuing that follow through by running up into more new highs. We're just sort of, poking up 1 or 2 days, rolling over a few days, and then, poking back up a few days. And that same sort of vibe is being seen intraday too. Was the overnight low, so I can get rid of that now. Need to mark the 30-minute low. Yeah, even something like widening your stop to -6 on the 15-minute orb. You think, oh, an extra 2 points. It's not, that'll be made up by the 20-point winners. But, you get 2-point loss, 2-point loss, 2-point loss. That's added on to the -4. And then all of a sudden it's like, oh, okay, yeah, -6 might keep me in an extra winner or two on certain days. But then every stop out is an extra 2 points. And you really have to apply it to a big data set. To, small windows, you're going to find there's always more profitable ways to trade that month or that couple of weeks, even a quarter at times. You could be in a 3-4 month trend, and a slightly different trading strategy would work a little better, but you need something that you can repeat. Our ticks are not really at any extremes. Nicey ticks here were only about -500 and not even +500. Okay, here's our first touch of the 21. And getting a little rejection here. Let's see. We did get a lift off the 30-minute low. And lift off right at the bottom of the hour on that business inventories housing market index. We can try a 13.25, although this is probably going to push up through the tail. We're in this bull flag, and then you have the hammer here and the inverted hammer, but it is an inverted hammer at the 21. We'll see if she goes. Okay, that's good. Almost. We're going to have a halfway back long here. Right there. Let's see if we can get that last tick. Come on, little guy. There we go. Cool. Look like we might bounce right off that 50, but I was able to get it. All right, so +6 on that little inverted hammer short. Now, if we start pushing up from here, we have the long in play. I could have flipped that for a counter trend, but wasn't quite ready for that. The 21 is a little close. That would have been an 11.25 long, and the 21 is only at a 15, so not quite 6 points. You see where, you got to ask yourself, what's the next resistance point if I were to go long? Well, if it's within the target, now you risk getting resistance before you hit your profit target. So I'll leave this 50% up here. The 21 is definitely flattening out a little bit more. It's not flat, but it's less steep, I guess, than over here. But really, really nice touch here of the 21. I know these two inverted hammers down here did roll over to the downside. But there's lots of instances where they create a higher low or ends up being like a longer term bounce. But now getting real sloppy through here. It's one thing if we bounce up cleanly to the opposing, but then it was back down to the 50 long, up to the 50 short. Now we're back at the 50 long, kind of chopping here. Remember, 30-minute range has really not been breached just by a couple of ticks, and then we bounced right to the 21. So this is kind of the inflection point where if we come back down to lows of the day, that's also the 30-minute low, and if we bounce, then we have a really good chance of just being stuck and moving back up to the top of the range to highs of the day. But if we break through, then we can continue shorts in this downtrend. Yes, you certainly can trail the swings, either the entire position or splitting it in half and having the +6 target, and then trail the second, if you got a second contract, or if you have 4 contracts, dividing it 2 and 2, 2 off at +6 and 2 to trail. I've been doing all of the contracts off at +6 pretty much since last summer, just as towards the end of summer, when I switched back to trailing swings. Over the summer, I was trailing each candle, and my thinking, oh, volatility's lower, I'll just, trail each candle, take what I can get. But that was not the best approach, actually, in low volatility, because as you would get in the trade, sometimes it would be so slow that it just kind of ticks around a little bit, and it would tick me out, and then it would roll over. And yeah, it would take a little bit longer to get to its +6, but it would get there. And, I was taken out for -1 or plus a half tick or something like that. So that made for a pretty lackluster summer. Wasn't a terrible summer. It was just, did not catch very many bigger moves that way. By trailing each candle. Sometimes you get into a trade and every candle makes a new low, and you're trailing your stop, and you end up with a 15-point winner. And so those were the trades that were a little few and far between over the summer. So then I switched back to just trailing swings. And first I was thinking, by being more aggressive with my trail stop, trailing each candle right out of the gate, I would cut my risk down. But so many of these trades, they either don't get follow through. Like, regardless if I'm trailing each candle, I might have my stop down at 2.5 points instead of a 3-point stop. But either way, it's a losing trade. Whereas if I, can give it a little more wiggle room, trail the swings, leave my stop at -3, and then start trailing once it makes a little bit of a bounce, you get a lot more winning trades in there. And a trade like this, pushes down before I even have a chance to move my stop. You're getting your target hit. Like the first swing high is right here. So if you did break it up, let's say you had 2 contracts, you had 1 contract with a +6 target, that one gets hit. The whole time your stop's at -3. Once it bounces, then bringing your stop, and then not just bounce, but comes down and breaks that candle's low to solidify it as a swing high, then you would move your stop down above that candle. So this one moved down. It ended up going up and touching the exact same high, so nothing to do with your stop there. Rolls over again. And then at this point, we've sort of, your stop would still be up here because you came down, then you came up here, made a high above the prior candle, but you haven't made a lower low. And so, your stop does end up being a fair bit away from price. But if you can get 2 or 3 rollovers, all of a sudden you can get those 15 or 20-point winners. But that's going to be maybe 20% of the time. And so you have to be able to take, this ends up being, you would end up around break even on the second half of the position. And so are you willing to give up a +6 on half of the position to see a +15 or +20, 20% of the time? Some of these, splitting up a trade like that can mentally kind of mess with your head. So you really need to just validate with the numbers over a larger data set, just like we've been talking about. So stop orders are typically by default a market order, market if touched, because if I have a 3-point stop out here and the market goes ripping through my order, once it hits that -3, if it just keeps going, which is typically what it's going to do, if it's a limit order as a stop, it's going to fill me at -3 points or better. So that would mean a -3 or better. If price is already through my stop and trading at -4, it's not going to fire off and close my trade until price retracts and gets back within that -3. So a stop order is default going to be a market order, and that's why you may have a tick of slippage on occasion if price just rips through your order. It's definitely more rare with the ES. You're going to see it more on like the Dow or the NQ. But and then for the target, the target is more of a limit order because it's going to need to trade through to fill you, versus market if touched. So sometimes what happens, and this is why it can seem like it's a market order, but if price comes down and touches your order exactly, and you're pretty early on in that line, first in, first out, it's going to start filling everyone at, like, the low of this candle here is a 675. So if there's 100 orders at 675 to buy and 50 orders at 675 to sell, it's going to fill the first 50 people. And if you're in the second half, you're not going to get filled at that price, or you're not going to get filled right on. It's going to have to trade through it to kind of finish all those orders and then move on to the next price. And then your order gets filled as soon as price trades through your order. When I'm doing like the 15-minute orb on that entry, that's also a buy stop or a sell stop. So as soon as price touches one tick below the 15-minute candle, it's firing off a market order. And again, because if price were to break the low of the first 15-minute bar and then keep going, and I'm not filled on the initial break, then I'm sitting up here with an unfilled order and price is, 5 points away. So for the same reason, you may have a tick occasionally of slippage, but it's worth it to get into the trade on the initial push. And that's the same thing with the hammers and inverted hammers. It's a buy stop and a sell stop order, not a limit order, because I want to get in as soon as price pushes through. And, with targets, especially on like the 15-minute orb, you're putting that 20-point target out there way in advance. And so I will more often get filled on a touch of plus 20 for the 15-minute orb than I would for a touch of plus 6. Like today, it came down and it touched a quarter, which was the exact 6.725, and it touched it, and then it kind of bounced off, and it touched it again, still didn't get filled, and then finally, once price traded through all those orders that were sitting there, then I got filled when it was down at 6.25. Well, we have failed to break below the 30-minute low. We're now at the halfway back short for the day. It's our first, and if we draw the halfway back long, we might be just about there too. Yep. This is one of the first halfway backs after a daily short that I've seen in a couple of weeks, where we have a larger 50% trade away, and then we trade up to the 50% of the 512. I didn't even have it drawn up, but yeah, we have not seen too many of those, so that's be nice if we could get some more of those on a more consistent basis. Yeah, it might be, Daryl, that it was a market order then. At the end of the day, one tick, slippage one way or the other. Usually you don't get the slippage in your favor. Occasionally, on an exit, I guess it's maybe happened 2 or 3 times where I've gotten filled at 6.25. Typically and that's over, 5 years, 6 years. It doesn't really happen too much. But if you end up with a stop of 3.25 instead of 3, or an exit profit of 5.75 instead of 6, when you plug in your R multiple ratio, it's pretty much there, 2 to 1. So that kind of slippage or stuff is not a big deal. Not saying that you were saying it was a big deal, but sometimes people dwell too much on the commission, and certainly, you don't want to be paying huge commissions, which, Thinkorswim does have higher commissions than Tradevate, and certainly higher margin requirements, which isn't a huge deal. But when you start to factor in that you need all this cash sitting there just to trade one full size ES contract, if you're going to get up into 3 or 4 contracts, now you're talking, $60,000 sitting in your account. That's the opportunity cost starts to really increase with what you could be doing with those funds, versus just having the cash sitting there. So that's why, a Tradevate, or I think Ninja's pretty low intraday margins too. Yeah, so Toss used to have smaller intraday margins, and then when they merged with Schwab, they bumped it back up to like 17, 18,000 per contract, and then it they just never brought it back down. They just weren't interested in drawing in futures traders, which is understandable. Yeah, there was a time where it was like $3,000-4,000, and that was kind of a period where might have been a little. I was on Infinity for a long time, but maybe towards the latter years of Infinity when I started trading, because Thinkorswim was really not very good for futures, and then the active trader ladder got a lot better. I started trading on it a little bit more, and the intraday margins were smaller. So, oh, good question, Stan. So for these 512 halfway backs, I don't use the 6-point target. I just trail. So I'll start so the first step would be, you get in the trade, a 2-point stop. And then once we break lows, I move my stop to break even. And then I will draw up the next 61.8 like so, and move my stop above that high, that 61.8 high. Then we go a little bit lower. In that case, since it's still pretty close to the -23, I would also just adjust the anchor point, and it may or may not adjust where I move the stop to, but I'm just doing the 61.8 round up to 1/4 and then add 2 ticks. And then the next rollover, I will start trailing the swing highs. So swing high here, one candle swing high here. I would typically tighten it and then be taken out over here. So what is that? An 875 and entry of, just call it 2350. So you're at, I mean, that right there is 14 points. So yeah, the halfway backs, the reward to risk is definitely a lot better with the 2-point stop, and you catch much bigger winners. But boy, they've been few and far between so far this year. You know, you'd have 4, 5, 6 trades in a session, and it has just been a slow end to the year and slow start to the year. So still a great trading strategy, low risk. Small losses, big rewards. But it's hard to get into a rhythm when you're not getting setups day after day after day. But this is the kind of thing that I would want to see. You get a larger resistance level, the halfway back of the day, meaning you grab from the high of the day to the low of the day, and then you trade at that point. You trade away from that point, take out a swing low, and then bounce back up to that 50%. And that 50% kind of lines up with the prior low as well. They don't always touch. I mean, this one touched really perfectly to the 50. Sometimes they go in a little bit, and that's totally fine. But these hammers here, this hammer here, yes, it's kind of a higher low, but we're just kind of in this limbo here. So I'm not really interested in counter trend. If we got a hammer on top of the 30-minute low where the tail stuck down below, maybe I'd consider that as a double bottom for a bounce long, but kind of treating this like a Monday, even though it's Tuesdays, because it's the first trading day of the week. So this tail, this hammer here, I would want the body to be a little bit lower where it's sitting right on top of the 30-minute low. Like I would like to see price to go below, what is that, 797.75, be rejected and then rally back up to the 30-minute low. So it wouldn't be like a perfect double bottom where both tails would touch 96.25. I want that tail to go down further and then see that rejection. Okay, here's our break of the 30-minute low. The safer play would be, if we push down here to the negative 23 and then bounce up to the 30-minute low for an inverted hammer for a short. And that's pretty dang close to a hammer, but our 21's starting to creep down a little too close here. I'm going to hold off on counter trend here. We're really starting to get this downtrend forming again. I'm just going to draw up this halfway back. I'm not going to necessarily place the order here. Let's see, Stan. Yes, we are at a prior gap fill. That is way back on middle of December. We did take out the low from the beginning of this month. So let's see if that accelerates us up or down. We are right at the tipping point or inflection point. We're either gonna break lows, being at that prior gap fill and low from the 5th and push down, or start to rally and come back into the 30-minute range. This is the point. Not getting a whole lot here. A little bit above the 30-minute low, a little bit below, but no follow through so far. Thought we might get a hammer, inverted hammer there, but nope. Well, up we go. That prior gap fill and 30-minute low seems to be holding and not able to come down and complete the negative 23, at least yet. But now we're getting fairly far up into the 30-minute range. This kind of smaller 50% retracement is kind of the last line in the sand to retest this swing high. That if we do roll over, the 21 could start to curve and then come down and get one more chance to push lower here. Came up into a high tick. Well, I think I'm going to wrap it up here, and we're well into the 30-minute range. There's really not much to do. So one inverted hammer short, that was a nice little bounce right to the 21. I'll take it and try again tomorrow. So I hope you have a great rest of your day. Just finalizing a couple things with the 15-minute auto trade as far as getting the account set up, and then should be ready to send that out. Basically, you set up the, like I said last week, open a brokerage account, fund it, and then subscribe to the service, and you're off and running. You can set it and forget it, and you'll have that 15-minute orb strategy on autopilot. So hope you have a great rest of your day, and I'll talk to you all soon. Thanks, everyone.